So good evening, everyone, and I welcome you to a session where we speak about the latest edition of our Alpha Strategist, which is a monthly research publication, which goes out to all our clients. The whole idea is to discuss markets, look at different asset classes, and give you a direction possibly of what to do on the portfolio. This is obviously based on our discussions at the investment committee and some of the data that we are observing. As always, we have an interesting theme every month on the report. This month's theme is Hobson's Choice. And for people who know about Hobson's Choice, it's really not a choice. And I think a lot of investors, not just in India, globally, are saddled with this. On one hand, fixed income seems to be giving close to negligible return or in real terms negative returns even in India, because inflation is above 6, and your bank FD after tax will give you less than 3. So you're actually earning a negative real return in fixed income, and globally the fixed income returns are close to 0. So I think equity then becomes an obvious choice for most portfolios, in spite of this disconnect in our minds between the economy and markets. And I think I've explained this, or I've given my views on this many times, that I really do not find a very large disconnect between what is happening in the markets and the economy. I do believe it will continue to exist till such time as things recover back to whatever normal that may be. And yes, there is a risk that if things instead of recovering start deteriorating again because of some event, then we may see valuations correcting back in equity markets. But otherwise, I think this disconnect will continue between fundamentals and prices for quite some time. So that's the Hobson's choice that everyone has to make in today's market. In terms of decisions, like I said, one can continue to hope that fixed income gives a higher return because fixed income gives us comfort, but obviously that choice doesn't exist today. So we have messaged this many times, and we continue to message that I think the best route to follow in today's complex world is to have an asset allocation at your level, whatever suits you. And we do have a concept called the investment charter. If your advisor has not made it for you, I would urge you to speak to your advisor and get it done, where you lay down the rules of the game up front. So we do continue to be positive on gold, and hence I believe that one should have a fair mix of asset classes. So I think this is the perennial tussle that people want safety, but today safety is actually eroding money for you, eroding value in real terms for you. Equity markets, like I said, can continue for quite some time, and it can be disconnected with fundamentals, and we'll talk about why it's not very disconnected with what we are observing. But with interest rates at such low levels and global central banks committed to keeping interest rates at low levels, this can continue for quite some time till things recover. So this gives you a sense of the kind of liquidity that has come in by major central banks across the world, and the cumulative number is quite large. I mean, this is Fed alone, which went from close to 3.8 to $7 trillion. So they infused $7.2 trillion. The ECB went from 5 to close to 7.5. So they infused another $2.5 trillion. So cumulatively, if you look at BOJ, if you look at China, if you look at maybe even Bank of England, cumulatively, that's a lot of money for global markets. And this time around, like I've explained, Fed has chosen to circumvent the banking system and put money directly in the hands of businesses and customers. So that's causing a lot of liquidity to come into financial markets in absence of the economy being completely open. I think as economy starts opening up, we will start seeing spending emerging in different parts of the economy. So the cumulative effect is almost close to $25 trillion. That's a massive number, right? $25 trillion is almost close to 27, 28% of global GDP. So that's the kind of liquidity wall that is coming at us, right? Now the net result of this is very, very low interest rates. I mean, in developed markets, interest rates are close to zero. So if you put money in a bond, you get absolutely no yield. And if let's say your expectation of inflation is 2% in the near future, then bonds will actually lose money for you in real terms. And that's what is driving further inflows into equity markets. I think emerging markets are similar. Yields have crashed to close to 4%. Now, inflation adjusted, I would say emerging market real yields are also in negative territory. So really there is little incentive to keep money in fixed income other than having a buffer or having some part of the money for contingencies. And the central banks of all these countries, you see similar trends, right? So this is one massive trend which is continuing. Now, Fed made changes to their policy, which has very significant implications for the world. And for the first time, Fed has said that their tolerance for average inflation will be higher, which means that normally Fed would get a bit perturbed if inflation started moving up to 1% and then 2%, and they would adjust the rates gradually so that there is no shock to the economy. But this time around, they have said that even if inflation rises to 2% or even higher, they'll have a longer room for tolerance, and they will look at average inflation rates as opposed to the headline inflation rates. So that leads us to believe, and many people around the world, that interest rates, low interest rates are here to stay, which means that negative real rates will be the order of the day for some time to come. Now, this has a lot of implications for many things, and we'll explore those through the course of this presentation. So in India, really, we've been slowing down for the last 3 years. I mean, 2 years in effect, right from 2017 to 2020. And this is on the back of multiple factors, which I don't want to go through again, whether it's demonetization or the implementation of GST, many other reforms which have been taken in the economy. And of course, we hope that the climax was the last quarter GDP number, which fell close to 24%. Obviously, we don't expect the numbers to remain at minus 24%. We'll gradually recover, and for the year, depending on which report you read, the estimate is as wide as minus 5% to minus 15%. So which means close to 10 lakh crores GDP lost to maybe 20-25 lakh crore GDP lost. GDP output of India last year was about 200 lakh crores. So obviously this will have repercussions in different parts of the economy, but remember, the impact will not be even. It will be very, very uneven, and I'll come to that when we talk about markets and the economy. The number which came in the fourth quarter, in the first quarter, obviously a large part of this fall was driven by pockets of the market which were completely shut down. India had the most stringent shutdown globally. Exports held up, net exports, and the reason for that is not that exports accelerated, is because imports fell sharply. Remember, imports are a function of domestic consumption. So with the lockdown, domestic consumption collapsed, and hence we had to import less of everything. And that led to a collapse in imports, which was faster than maybe, growth collapse in exports. So net exports was positive, which means the current account is being very stable for India. and that is also reflected in the appreciating rupee. It is further bolstered by massive inflows into India this year from FIs as well as FDI. Rest everything fell, and this is probably the worst contraction, and it's a contraction in more than 40 years. So it's pretty bad. This is a pretty interesting chart if you want to look at leading indicators. These are the leading indicators for consumptions. And just to explain, how this works, basically pink means that it is worse than the previous month and the year, which means it's a very bad reading, the pink number. Right? The yellow number, which means that it is worse than the previous month, but year on year it is better, right? Blue means it's better than the previous month, it's worse than a year ago. Green is what you're looking for. So green means that there is growth. Okay. So these are different lead indicators we look at to track consumption growth, whether it's passenger traffic in railways and airlines, petrol sales, rural wages, auto sales, imports, foreign tourists, so on and so forth. Obviously, foreign tourists and imports have literally collapsed. It has fallen by 100%. Now, if you look at the other indicators, some of them are recovering very fast. So if you see revenue spending by the government is obviously recovering and is better, much better than the previous month. The blues all indicate that you're better than previous month, but worse than a year ago. But just look at this, petrol consumption is down 10%, which means it has come back to 90% utilization rate. That's the way to read it, right? Rural wages are 96% of what they used to be. Consumer durable has already come back to 73%. So the bounce back is very, very sharp, right? And month on month, if you see the trend, as things are opening up, the bounce back is also pretty sharp. So the recovery has been pretty impressive, to be very honest, across many segments. But like I always say, that you'll need to see the trend over 2-3 months to make an opinion on whether this will continue and what will be the new graph for GDP. These are the indicators for investment. Investment obviously has been probably less hit because it is the industrial side of the economy, and a lot of it is on the rural, semi-urban side. So a lot of it is recovering quite smartly. The only thing is which is hit still badly is commercial vehicles, because commercial vehicle is a proxy for investment side of the economy. But net, the summary is that things are recovering fast. But like I said, we'll need to see another 1 or 2 months trend to make an opinion. But August, we saw the auto numbers, and auto numbers have recovered pretty smartly. Two-wheelers, four-wheelers, tractors have been doing extremely well this year. Commercial vehicles, we sense, will take much longer. If you look at this is an interesting chart that credit to deposit growth, credit and deposit growth. Deposit growth has been growing, but credit has been falling. Okay, which basically means that banks haven't gone into this storm or pandemic at a fast speed. They've gone in at a very slow speed. It's not that banks, NBFCs were lending left, right, and center. And that's the reason, we are far more, if I may say, less pessimistic about NPAs within the banking system. Yes, there will be NPAs. Yes, there will be provisioning. Some of it may get softened by the restructuring plan that RBI has put out, or the government has put out. So we are less worried from a liquidity point of view, or from a point of view that it may lead to large-scale net worth erosion. I think the worst is behind us in terms of the credit cycle. Post ILFS, a lot of NBFCs became very conservative. Similarly, since 2014-15, banks have been provisioning for large NPAs. So compared to that, I think you will have a muted impact comparatively, relatively. And banks have a large capacity to lend. So tomorrow, if India recovers smartly and there is room for growth, then banks have enough operating capacity to lend. That is denoted by this credit to deposit ratio. It basically tells you how much credit the bank has given as opposed to the deposits. So normally it is 70-80%, but today it has collapsed to 50%, which means banks have a lot of room to lend without having to raise additional resources in terms of deposits. Right? Now, this is the real big silver lining for India. What has happened is there are 2-3 things which are playing in favor of India. One, okay, the first 2 months, yes, as I said, imports collapsed because our consumption was down on account of the shutdown. But incrementally, what we are observing is crude oil prices are very reasonable at very reasonable levels. I mean, it went all the way up to 80 about a couple of years back. Today, you are at 43, 45, and the incremental outlook for crude, because global GDP growth is expected to remain weak, will be weak. And there are structural drivers against or headwinds against crude in terms of, renewables, electric energy, so on and so forth. So on the whole, we believe crude oil prices will remain reasonable. Now, this is a big blessing for India because high crude oil prices are basically a toll tax on India. We lose about 2% of our current account to crude every year, right? The second silver lining can come from this accelerated push towards manufacturing locally. So if you see, government has identified sectors which are high import sectors, whether it is electronics or whether it is certain chemicals or niche areas. Now they are moving to get India to ramp up manufacturing in these segments. So electronics, you can already see a massive push. There are a lot of contract manufacturers which are ramping up capacity. A lot of global brands who are setting up manufacturing units. I mean, one of them is Apple. I mean, what we believe is, Foxconn has set up shop in Chennai, and Apple could soon start shipping goods from India itself for India. So I think a lot of this will also contribute towards ensuring our current account is very, very reasonable, right? Once growth picks up, I think you may see a deficit, but deficit will continue to be 1.5%. And you are seeing massive inflows into India, FII inflows as well as FDI inflows. By the way, year till date, okay, including the Corona period, we are net positive about $6 billion. So even on an incremental basis, I see that, the foreigners are far more bullish on long-term growth in India than a lot of domestic investors today. If I just purely go by the net sales data of mutual funds. So this is going to be a bright spot, and hence we believe that rupee may not depreciate much in the near term. And this will definitely help us manage our local conditions better. How? Because if RBI is not worried about the currency, then they can focus on ensuring orderly transmission of interest rates, which can lead to faster healing of the economy and coming back to growth. So this is a big bright spot for India, I believe, and I think it will continue to be a bright spot going forward. And this is what I was mentioning. I mean, in normal crisis times, rupee tends to depreciate. If you see 2018, if you see 2013, right? Normally in crisis periods, rupee depreciates. Okay, again 2016, you will see something similar, right? But here, even though you saw an initial bout, but after April, rupee is actually appreciated. So this is a big silver lining for India, and reserves are close to $500 billion. I believe that in another 5-6 years, we will reach $1 trillion. This was about oil. Like I said, forecast is that we will remain in a reasonable zone for longer, and this is a big blessing in disguise for India. Then there are some data points, and I think I've spoken about it, so I won't spend too much time. I mean, if you look at two-wheelers, whether it's Bajaj, Eicher, different segments, TVS, Maruti, M&M, Escorts, very, very smart recovery. Yes, commercial vehicles normally take longer because once capacity utilization goes up, there is additional demand for capital goods. That's when it starts picking up, but we believe it's a matter of time it will pick up. GST collections are an area of worry, right? I mean, we saw some pent-up collections in the month of June. I argued also at that time it is probably partly because of pent-up collections coming in here. We are currently at 86, 87,000 crores. Our estimate is the center will lose close to about 1.5 lakh, maybe 2 lakh crores of GST, which it will have to make up through additional borrowing. And this stiff with states is all about GST compensation, because when GST was rolled out, center had mentioned that they will compensate the GST loss for the states. But to be fair to the center, I don't think center had envisaged an emergency situation like COVID. So I do believe that this will be a spot of bother for the government. So they need to come up with innovative ways to fund our deficit this year, whether they choose to do it through monetization by asking RBI to issue more currency, or they get some special bonds issued so that foreigners can buy, because there is a lot of appetite for India. Time will tell. I think we will see how it progresses. Inflation, like I said, is the last number came in at 6.9. Now, a lot of this inflation spike we suspect is because of supply side disruption. See, demand has collapsed for a lot of services, goods, commodities. However, inflation is spiked, right? And we believe the reason is supply side. So supply side is still disrupted, and food and fuel has been a major contributor of this spike. But I wouldn't say that it is the only contributor, because if you look at core inflation, if you strip out food and fuel, it is still high. It is close to 5.6, 5.7%. So inflation is a spot of worry, but the central bank will not worry too much about it in the near term, because they know it is not happening because of demand side, right? It's not that too much money is chasing. I mean, too much money is not creating too much demand, because everybody is sitting at home and things are shut down. So I think the RBI will continue to be a little loose on its monetary policy and ensure rates are low. At some point, if inflation doesn't come off, then they'll get worried, but we do believe that it should come off at some point. Fiscal deficit numbers will only widen this year, and I think most rating agencies will be okay with it as long as they see that this is widening on account of temporary funding to substitute the gap created by this pandemic. Rest we spoke about, so I'll move ahead. So what does that mean for fixed income? Let's talk about fixed income first, and then I'll come to the equity view. Fixed income, we believe that interest rates are probably, or at least policy rates are close to all-time lows, right? What is currently happening is RBI is trying to transmit interest rates to different parts of the market. And what do I mean by that? You look at this, RBI has kept liquidity very, very high in the banking system. This means negative liquidity, this means positive liquidity. So it was almost close to 5.5 lakh crores. It is still very high at 3.5, 4 lakh crores. In normal times, there is a liquidity deficit of 50,000 crores to 1 lakh crores. So just oppose that with 4 lakh crores of excess liquidity. So they're continuing to keep a lot of money in the system so that everybody gets a flow of credit easily. And but 10-year bond yield is close to 6.12, and it has spiked because people are now worried that the government will borrow more to fund the fiscal deficit, which is the valid worry, right? And hence bond yields are spiked. But like I said, RBI is very focused on this, and hence the moment they see yields going up, they come out with a bond buying program. Recently, what they also did was they allowed a lot of banks to push long-term bonds into what we call HTM bucket. What is HTM bucket? Is hold to maturity. So when banks push bonds to hold to maturity, they don't have to mark to market in their P&L. So the volatility reduces. So banks can buy more bonds. So that creates demand, right, automatically. And like I said, they will need to find innovative ways to absorb the government borrowing program, which I think they will. They have got a lot of tools. We'll see what tools they employ going forward. So this is what I was saying. There has been a orderly collapse in yields across the board. So if you look at the GSEC, there is the government bond yields, right? Now, this is onset of COVID, the red line, right? If you see the short-term yields were close to 5.2, 5.7. They've collapsed to 3.75, 4.5. So they've collapsed sharply. The yield curve is steep. See, the longer-term bonds had come off, but they've again come closer to where they were. So this is the cause of worry. So what RBI is also trying to do is reverse operation twist, which is, buy bonds here and issue bonds here to flatten this yield curve. Similarly, AAA bonds have also collapsed in terms of yields. Today, 3 to 5 year money, good quality corporates can borrow at 5.5%, 6%, which are very, very cheap rates. Even AA bonds, which were very high, if you see during COVID times, 3-year bonds, people had to borrow at 7.5. Now, depending on the name, the rates went as high as 10, 11, 12 also. But now they've collapsed to again 6.2, 6.5%. Same for single A. Of course, even today, depending on names, even in single A, there are some issuers who borrow at 10, some issuers who are able to get money at 7. So there is a discrepancy, but at least today I can say confidently that any reasonable sized NBFC is getting money in the bond market. There is no problem of liquidity, and hence we don't believe there is a problem of solvency today. And a lot of banks have raised money, NBFCs have raised money, so they are comfortable. So I do believe that the credit crisis is behind us as we speak. So there are, in a fixed income, our strategy is very simple, that you should keep 70-80% of your portfolio in very high quality, which is your banking, AAA kind of bond funds. Keep your average maturity low, okay, 2 to 3 years, 2 to 4 years. Now, which means over the next 3 years, you will collect maybe 5.5 to 6%. Right? In mutual funds, you'll get the tax benefit also if you stay more than 3 years long-term capital gains. But I think this is a time to be defensive and collect that 5.5 to 6%. Okay, maybe 20-30% of your portfolio you can augment by buying selectively certain bonds. I mean, we are also pretty active now on the bond desk. There are some bonds which are very attractive from a yield point of view. So you can look at, augmenting the yield with those bonds, or, there are certain structured market linked debentures that we are issuing from our own balance sheet, right, which are offering higher yields. So you can augment your core safe portfolio with some high yield bonds and debentures to arrive at a yield which is reasonable. But the strategy should be to be defensive, keep maturities low, because interest rates are at an all-time low right now. Now, coming to equity, I think equity continues to rally globally. If you can see the global indices, they're doing extraordinarily well. I mean, Shanghai is up 10% for the year. Nasdaq is up a crazy 30% for the year in spite of the pandemic. S&P 500 is up 8%, and even Nifty has recovered most of his losses. Right? Because what, and I'll come to that analogy, market has basically brushed aside this pandemic because most governments have substituted this loss of GDP during this period by a lot of liquidity. And I think the recovery is much faster than what people have expected. The rally is broadening. 2 months back when I showed people this slide, only this part, that is the top 5 stocks in the S&P 500 US, were giving positive returns. Okay, rest of them were negative. Now, if you see, rally is getting deeper. So these mid-cap, small-cap rallying is not only an India phenomenon. Globally, they are beginning to pick up because of the liquidity and valuation mismatch between the mega caps and the small and mid caps. Now, this is an interesting chart. If you see, technology has become 30% of the broad market index in the US. Of course, this time technology is different to technology of 2000 in the sense here it was about internet, eyeballs, so it was about email, basic services like Yahoo and all that. This time it is about platform companies like Facebook, Google, But either ways, if I look at this chart and market cap to GDP, I will be very cautious on US markets. Very cautious. I mean, it's all the rage. It's very popular because of past 5-year returns. That's it. People are getting very excited because returns have been crazy. But I can tell you by experience that whenever things are in such a tear and people are saying nothing can go wrong, right? One has to be extremely cautious. So I'll be very cautious on that part of the market. US investment as a diversification from a longer term point is a good idea. But even if you want to diversify and build a certain exposure, do it very gradually, right? Because the markets are clearly overvalued there. Big time, right? And you can see it from here. US is 184% market cap to GDP. India is hardly 80% market cap to GDP. So India valuations are at reasonable levels, whereas US markets are extremely expensive. Now, this is a very, very interesting chart. And this is what I was saying, that what the markets are doing are not very disconnected with the economy. See, what is happening is I mean, again, anecdotally, when I say you or me, it's all of us. We are anecdotally looking at businesses next to our house or friends' businesses, the small businesses, the tailor next door, and we are saying things are very bad, right? But Nifty, which is the market barometer, is not comprised of those small businesses. Remember, there are close to 17, 18 lakh businesses in India. Nifty has the top 50, which means they are the best of the best in every sector, right? So that is point number one. It is not the small business based on which you are making your assumption that things are bad. Okay. Second, if you look at the composition of the Nifty, right, 34% is financial services and a large part of it is private banks, which have not been that impacted. Okay. Whereas if you look at the GDP composition, financial services is a much smaller part, right? Similarly, if you look at consumer goods, it's 13%, whereas consumer goods in the GDP composition is a small number, right? Agriculture is a very large part in the GDP. Nifty, agriculture is hardly represented. IT is 14% in Nifty. IT has hardly any representation here. So the point I'm trying to make is GDP falling 24% is not the same as Nifty, right? These are the best of best companies. And for the year, we believe, looking at the results in the first quarter, which arguably was the worst quarter, for the year, Nifty earnings might maybe fall only 5 or 10%. So which means for the year, it's not a bad outcome considering that you're going through such a massive storm. So I think one has to clearly distinguish between when we, generalize saying, oh, GDP is bad and markets are bad. I mean, it is not. These are the best 50 companies in India, right? Infosys is not a local software company, or let's say even in real estate, right? Real estate, if you see a large part, 16% of the GDP, here there is no real estate company in the Nifty. So the impact on Nifty is very different to GDP. I would argue, in fact, these Nifty companies are actually beneficiaries of this crisis, because in sector after sector, we have witnessed that these large companies are taking away market share from a lot of the smaller players. So I think this is a disconnect that one has to come around to it whilst one is investing. Again, we saw this polarization in a few stocks over the last 2 years. I think it is getting better and the net is getting wider now. Right? I will just go to this. If you see now, right, mid and small caps are already outperforming the Nifty. This was our hypothesis at the beginning of the year. Okay, and I do believe that mid and small caps will continue to outperform, right? And the reason for that is pretty simple. That they're starting with a very low valuation, right? So a large part of this rally is coming back to average valuations. Over the last 2-3 years, a lot of the medium and smaller firms, right, have seen multiple headwinds, whether it was GST implementation, whether it was, RERA, etc., etc. And the cost structures for many firms have come down to the bare bones, right? And the survivors are extremely good companies. So from now, if let's say we go into an expansion phase or GDP growth phase next year, year after next, a lot of these companies can have outsized profit growth, right? And that is what the market will start factoring in the second phase. If you see down, small caps are still 30-40% down from their 2017 highs. Mid caps are still about 20% down from their 2017 highs, December 2017, right? So there is still a lot of catch up to happen. And this ratio I highlighted earlier as well. Why we believe mid and small caps are undervalued. So we continue to believe. Again, that doesn't mean that you do a binary shift and go into mid and small caps. I think you need to take a portfolio level view and have a slightly higher component of small and mid caps in the portfolio. So if you decide that, you know, from a longer term point of view, you like to carry 20% small and mid caps, 30% small and mid caps, then maybe this is a time to have 40. Right? That risk control has to be central to portfolio construction. Yeah, I'll run through. So this is our temperature index, which I normally tend to highlight every time during our Alpha Strategist session. Only caveat here is this is Nifty, right? So this gives you valuations of the large cap part of the market, which is 80% of the market. So last 2 months when I spoke to you, I think the valuations were still very reasonable and average levels. Right now, this index is at 115. Okay. For people who may not have attended my earlier sessions, just to quickly explain how this works, is this temperature index has P ratio, PB ratio, dividend yield, and the prevalent government bond yield, right? All incorporated into a secret sauce at our end, and it is averaged out at 100. To keep it simple, below 100 means markets are below average valuations. Above 100 means markets are above average valuations, right? So if you see during the 2002 bear market, it went closer to 60. Again in 2008, it hit 60. And even during this March crash, it went closer to 65 thereabouts, right? So what is this green part of the chart? This is basically if you had invested here, what would your 3-year forward returns be? 3-year CAGR. Huh? So if you see 3-year CAGR was 60% per annum, right? Similarly here, if you had invested, the forward return was almost close to 27-28% per annum for 3 years. So clearly when this index is low, it tells you that investing in Nifty, even Nifty is a no-brainer, right? Similarly, when it goes up, if you see here, valuations were very high in 2007 because of the bubble, right? The forward 3-year returns were negative here, right? So it's a very good indicator of large caps or Nifty. What is it telling us today? It is at 115. So below 95, right? Whenever this index is below 95, in this fall we went to 65, right? It was a no-brainer. 100% of the time Nifty has given more than double-digit returns over 3 years, right? Today we are at 115, which means your probability of getting double-digit returns over the next 3 years on the Nifty is low, right? But you'll still be positive 89% of the time. So if someone has the ability to now pick out companies, maybe they can do a bit better, right? So we believe that on the large cap space, one has to be a bit cautious. The broader markets is still okay. So what does that mean in terms of portfolio allocation? So first of all, you have to see this is large cap, right? So whether large caps are expensive, fair or cheap. I would argue in terms of valuations, we are at the cusp of fair and expensive, right? If markets go up, we become expensive, right? So in fair zone, what are we recommending? We are recommending you should put 50% of the incremental. So the second thing you need to ascertain, just looking at valuation is not enough. You have to look at your portfolio allocation. Are you underweight to your equity allocation? Are you fully invested or are you overweight? So depending on that, we prescribe different actions. This is for the large cap part. Small and mid caps, like I said, I'm still positive. The valuations are still reasonable, right? Multi caps are still reasonable. So if you were fully invested, we would say today is to stay invested, right? Because we are here, right? If you were underweight, which means you still had money to invest, for some reason you withdrew money because you were scared 2 months back, then you should put 50% of the amount right now and 50% you should stagger. If it becomes expensive, right, then actually if you're fully invested, you should be reducing allocation, Similarly, if you're overweight, you should be reducing. If you're underweight, then no action, right? So when you're reducing also, we say you should reduce in a staggered manner. So this is how we manage asset allocation for clients. And I thought that will be useful to understand. So we have many other good information points in the Alpha Strategist. I think gold is another asset class that we continue to be positive. And one of the two reasons actually, one, US dollar is in a depreciating mode because the US government has put out a lot of liquidity. Typically what happens is when a country like US or Japan puts a lot of liquidity, people tend to borrow in that currency and invest in other currency as risk taking again starts. And I'm already seeing it happening, risk taking, because India has already received $6 billion YTD in spite of $8 billion going out in March. Okay. So dollar depreciates. Now dollar depreciation is good for gold and even other commodities, hard commodities, right? So this is one reason. Second reason is gold is a real rate story. What does that mean? Which means that when your real rates are positive, gold underperforms, right? I'll explain this. So let's say you, in earlier times, you were getting fixed deposit rates of 7-8%, let's say 8%, and our inflation was 3%, right? So even after paying tax, you will end up 5%. So you make a 2% positive real return, right? So people tend to rush to debt, fixed deposits, right? But when real rates are negative, like today, where post-tax return and deposits are less than 3 and your inflation is close to 6.5. Similarly, in the US, inflation is rising to 1%, rates are close to 0. In negative rates, gold becomes more attractive. So we believe these real rates will be negative for time to come. And normally those times are punctuated with very good performance for gold. Of course, you won't see the 40% kind of rise that we saw last year, but still carry some gold in your portfolio. Could be 5, 10, 15, depending on the kind of portfolio you constructed. It has to be different to different investors. It can't be one size fits all. Thank you. Thank you very much.